1909 hours. Someone need to close the executive session and seal the minutes?
Motion to close executive session from today, December 10th, and seal the minutes.
Second.
Motion made and seconded to close the executive session and seal the minutes. All in favor?
Aye.
Aye.
Opposed? Motion carries. Okay. Will you please stand for a prayer? Dear Lord, look over the people who lost themselves, their valuables in a fire over this past weekend. Firefighter who has lost his life in the past day in Worcester. Our military people serving overseas and here in the United States to protect us. Amen. Pledge allegiance. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Roll call.
Albert Hero,
Here.
David Lemoy,
Here.
Colleen Tay,
Here.
Fred Gill, Ralph Salmanese.
Here.
Okay, next is item E, approval of minutes from November 19th, 2018.
Make a motion that the minutes of November 19th, 2018 be approved.
Second.
Motion made and seconded to approve the minutes of November 19th, 2018. All in favor?
Aye.
Aye.
Opposed? Motion carries. Board council report, we're going to do that as we go through each of the items down the
We'll
road?
do it as each agenda item.
All right. Item G, what we're going to do is the Rockland report, the clear book will be covered when they do their presentation. Under Rockland, for this period, the beginning market value was $29,926,453.93. Change in market value was $452,417.15. For an ending value of $31,687,295.58. And that is going to be a gain of $200,808.08. From the first of the year to the end of November 30th, there was a change in market value of with a loss of $882,613.62. Our ending value is, again, it's $31,687,295.58. Does anyone have any questions? Okay. Item H, payment of bills, we have one, Bowler and Penza, MVF 7372, the amount of $1,998 for October of 2018.
Motion to pay item H1.
I second the motion to pay item H1.
Motion made and seconded to pay item H1 for the amount of $1,998. All in favor?
Aye.
Aye.
Opposed? Motion carries. Item I is Clearbrook presentation. Thanks.
Good evening, everyone. And just in case, happy holidays. Merry Christmas. Just a real quick review on what's going on, if we can figure it out, what's going on in the markets, where we are today, and hopefully where we will be in January of 2019 at this point in time. The markets since October have been very, very negative, obviously. Okay, the first point that came out that was very, very negative to the stock markets around the globe was essentially the Fed chairman, Jay Powell, making a flip comment on TV. So the lesson to be learned is he should never go on TV, which is basically the lesson. So there was a interviewer who said, so what do you think about interest rates? And he made a comment. He said, well, we're way far away from what they would call the neutral rate. Okay, the neutral rate from the Fed speak is an interest rate that's high enough to make sure inflation doesn't run away, but it's not high enough where it's going to stop economic growth. Okay, the market has always, for years now, since the Fed started moving interest rates from December of 2015, has always figured that they would stop raising interest rates when the short-term rates got to 3%. Okay, we started basically at 0. Now we've raised it 9 times to where it's about 2.25%. In 2 weeks' time, they're going to raise it by another 25 basis points to 2.5. And it was always figured that they would stop in around 3%. When Jay Powell made that comment, all of a sudden the market said, wait a minute, you're not stopping at 3? You're going to 3.5 or 4? What's the situation? So as interest rates go up, people look at now other investments, such as stocks, in a different way. Because when you have a bond yielding 3% or 4% versus 0, now you have competition for your money. So that's when the equity markets started to go down in October. That got worse, as now what we have today is you have the trade war with China, effectively, what's going on. And what does this all really mean to investors and folks like us? Interest rates go up, trade war goes on, the economy goes down. The economy goes down, it's not positive for stocks on a forward-looking basis, okay? But the one thing that folks are not realizing or not looking at is, you look at economic growth in this country, we did over 4% in the second quarter. We did 3.5% last quarter. We're still going to do pretty much close to 2.5 to 3% this quarter. By any stretch of the imagination or looking at the past, it's still pretty darn good, okay? And then when you look at earnings for the stock market, the S&P 500 in particular, last quarter, earnings in the United States were up 28%. That follows 25% in the quarter before and 25% in the quarter before that. So we've had 25 to 28% earnings growth this year at this point, which makes it today, based on fundamentals and earnings, a stock market that's trading at 15 times earnings, which historically, over the last 5 years and 10 years, it's below essentially the value where they were for a number of years. So it's now investors looking at, what are you going to do for me lately? What have you done for me lately? Okay. Can we make sure that the Fed doesn't raise interest rates to where they're too high, where stocks become overvalued at this point in time? And the guess is today, Fed will raise interest rates in 2 weeks, as we mentioned. Now the question is, will they raise rates in March of 2019? Right now, a lot of the folks are saying it's now a 50-50 bet. Before it was like 75%, 80% that they were very sure that they were going to raise interest rates many more times in 2019. With the markets coming down and all this slowdown in the economy, what we're seeing around the globe, they may stop. The other point is, if we make any headway in terms of trade negotiations between the US and China, that'll help the underlying sentiment in the market today. So in short, what's happening is all the economic data, all of the earnings support that the market should be higher, but it's not because of the worries and the concerns of where interest rates may go and what's going on with the China and the US at this point. And that's what's really impacting the portfolio and imparting essentially investments across the globe at this point in time. So I'll stop there and just answer any questions anyone may have.
I just have a question, to the chairman. You read a statement that said, from the beginning of the calendar year to the end of November, the fund balance had lost about $800,000.
860.
Change in market value was $882,613.62.
I'm just curious, asking these gentlemen, I believe our number, the last time I attended one of these meetings with you folks was about 34 million. And so if you only lost 800,000 from January to now, was that money lost last fall?
Yeah, from October and November. If you look at the markets in general, whether it's in the US and or overseas, those markets were down anywhere between 5 and 10% during that time.
So we're down a couple of $1 million.
Last month it was 1.8.
Yeah.
Last month it was 1.8?
Yep. There's been contributions and withdrawals during that period to pay.
I was just comparing January 1 to now. So
Yeah, I know what
That-
you're
that
doing.
34 million
I'm trying
may
to compare it to the last time I was here.
that may have been when the market was up. We may have been up in May or June to
Right.
34 million.
Right.
I
But
think they came annually, we came last. a
They
year
come-
ago.
they-
We come every quarter.
quarterly, yeah.
I think I got the meeting last October, not this past October, a year ago,
Yeah.
and it was like 34 million change.
I'm not sure, yeah.
And so you dropped 2 million plus since then.
Well,
It
there's-
didn't happen this last 8 months, because you only lost 800,000.
Well, it's also balancing, as John mentioned, also contributions and withdrawals for benefits on an annual basis as well, so that takes that into account also.
Is the ARC being paid? The annual required contribution being paid?
Yes.
Yes.
Yeah.
Yes,
I mean, for the most part, it was $750 a month that you were withdrawing, and I think it's increased a little bit recently. It's around $820.
Well, I'm looking at this, from January 1st till November 30th, the additions were 9.9 million and the withdrawals were almost 9.3 million. So the additions were slightly higher than the withdrawals.
The
But the-
additions were higher than the withdrawals?
Right, but
Not much though.
just a little bit, like, 6 million,
I'm just curious if
600,000.
that's the case.
About 600,000, but that, there's additions and withdrawals, but then there's the value of the stock, and so that's really what's gone down here, is a change in market value.
right.
One thing you gotta remember too is that Rockland's numbers don't include a couple of the alternative funds. So if you were to look at our total market value when looking at Clearbrook, it includes a couple of other funds. The value as of November 30th was $34,590,313. So that may have been where that 34 million is coming from.
Right.
So the fund balance is actually 34
It's
million?
34
Right.
for whatever
It's
reason.
34.
And I don't know if you guys can speak on that more, but there's alternative funds that can't be included in Rockland's numbers.
So,
I thought we agreed that that was always gonna be included.
That can't be.
well, it's included on this sheet, if everybody has the Clearbrook performance report. On page 3, there's total alternatives. So you have the first line item, which is Blackstone Alternative. That's a mutual fund, so that can be held at a custodian. But Graham, Davidson Kempner, and Renaissance are limited partnerships, and they are not held at the custodian. So that's roughly 4 million, 4.5 million, that's not included in the
In Rockland's.
Rockland statement.
So our actual fund balance in the pension plan is, as of November 30th,
34, 590313.
34.
Right.
It's the top of page 2.
Right.
You're welcome.
That-
We're at a
blue
point
line.
now, right,
Or
that
the black.
we're almost status quo of spending money every month compared to what we're taking in. Right, we're almost at that figure now.
Yeah.
Almost.
Where
Almost, yeah.
we're gonna start paying out more than what we're actually taking in. And that's a scary thought,
Yeah,
correct?
Correct.
Because we have more retirees coming
Yeah.
and payouts and all that.
actually,
Right.
their report's gonna talk about that because it's in there. They did a nice chart on that one.
What I'm curious about, guys, is international equity. But a lot of what you spoke about had to deal with some of the domestic issues that we're dealing with. Why is international so poor year to date? I mean, we're negative 11%.
Yeah, it is.
Can you speak as to what you expect to see over the next few months in international? Should we make changes in our?
Yeah, absolutely. You know, and it's interesting. International's done really poorly this year for two reasons. One is particularly the emerging markets has done really poorly because of this China trade, U.S. trade war that's going on. That's first. Second is the other international, particularly Europe. Europe is a mess right now, as we know. Italy can't get a budget. The UK doesn't know if it's going to leave the European Union or not. As of last night, Theresa May's in big trouble. She can't get her party to agree on the agreement, and they have a serious problem. And then you have the problems in Germany as well, where there's a huge economic slowdown. So to your point there, yeah, you know what's funny? We were talking about this planning for 2019. We're going to make a change. And probably what you'll see within the portfolio is there's two areas that are very, very attractive today from a pure value perspective. One is the U.S. is still going to grow okay next year. We're looking at about 2.5% GDP growth, which, again, it's not 4, but it's not a recession, right? U.S. earnings next year for the S&P 500 is going to be about 10%. Again, it's not 20, but still, it's not a recession.
Right.
So we're going to probably take some of the money, particularly in the mid-cap area, move it more towards higher quality, large cap, which will do fine. And then on the international side, the one place we'll probably lower our exposure is to Europe. And where we're going to move it is going to sound counterintuitive. We're going to move it to the emerging markets. And here's the reason why. Emerging markets next year are going to grow probably on a growth basis by about 4.1%, led by countries like India, particularly. India is going to grow about 7% next year, which is even better than China. Okay, so we're going to probably add one international manager who we actually have already identified for about 3% of the portfolio. Why? If you look on a valuation perspective, the U.S. equity market today, as per a price-earnings ratio, PE ratio, as everyone always talks about, is trading at 15 times earnings. Okay, Europe is trading at 13. Japan's at 11. Emerging markets are at 10. Emerging markets are at 10. Wow, that's cheap. Okay, so what's going to change the dynamic? Why should emerging markets come back next year? There's two important reasons why. Energy prices are down. You know, it's funny thing is a lot of folks look at the stock market and what. Do you know energy, oil is down about 25% in the last 6 to 8 weeks? Oil was trading at $70+ a barrel. Now it's just about 50. So when inflation comes down and the cost of energy comes down dramatically, emerging markets that import all of this, they'll do better.
Okay.
Second is the dollar is going down now. So it makes everything cheaper for them as well. So those are the kind of changes and you're absolutely right. We're going to avoid what's going on in Europe. Let
All
them
right.
figure it out.
So there's still opportunity internationally, just not Europe right
Yeah,
now. Okay.
absolutely.
And just to point out something with the report, so we have made changes.
I've seen,
Um,
yeah,
but-
yeah.
And the 11.7 includes the performance of the managers that we got rid of.
Right.
So, any other questions? Jim?
Yeah,
I had the question if you want to
Answered.
allocate.
Okay.
I have a question. When you were here the last time, I asked a question about what changes you were making in the bond and fixed income areas in view of the rising interest rates and the somewhat decline in the price of the bonds and so forth.
Yeah.
And you mentioned a product that you were getting into. Could you, do you have any more information about any other new products that you're getting into to make these adjustments in that area?
Yeah, it's a great question. So what we did just about a month and a half ago is we invested in a fund that buys short-term, very, very short-term, usually 1 day to 1 week loans to big financial institutions like banks and what have you, okay? The underlying yield to that now is about 2.3%. So all we'll make is about 2.3%, but as interest rates move up, the yield on it will move up as well. And that's on the line item here on page,
It's on page 3.
on page 3, and it's called the Clear Shares Ultra Short Maturity Fund. So you see it made 0.4% over the last 3 months, and as interest rates are going up, that's gonna basically go up on a month-to-month basis as they go up. When we started it, it was below 2%, now it's over 2%. So it keeps going up as interest rates rise. But what's nice is it won't go down in value as interest rates rise, which is very, very
Because it
important.
always resets every
Every day,
every day.
it resets every day.
The rate as well as the yield?
Yeah, the yield is about 2.3. And every time interest rates go up, it'll go up with it as well.
So we got rid of a fund, Double Line. That was the trade, if you will, the switch that we made. And that fund is down 75 basis points since we did it, and Oprah is up 40. So fairly sizable difference.
Yeah.
And these clears, and there's sort of like a guarantee to maturity sort of a thing?
Yeah, it's actually rolls daily or weekly, so it's not outstanding at all. It's backed by AAA rated treasuries or AAA rated mortgage securities.
Treasuries.
Only AAA.
But
Nothing more.
I just want to make sure we're clear, though, that it's an exchange-traded fund, it's an ETF, that holds these repos that Tim's talking about, that are backed by treasuries. So the actual security that you're invested in holds securities that are guaranteed, but the ETF is not. Just want to make sure we're,
Thank you.
yeah, sure.
The only other change you may see over the next couple of weeks between now and the end of the year is, you bring up a great point. As interest rates go up, what's going to lose money is one fund in fixed income, which is the Vanguard Intermediate Fund, which is down about 2% for the year, okay? The reason is because it has it has a duration of about 6 years, okay? As interest rates go up, it will lose money, even though it's yielding about 2.5%, give or take. What we're thinking about doing is, there's a fund out there, FLOT is actually the symbol. It's called Float. And all it is high-grade companies, corporate bonds, okay, all investment grade, triple B or above. So it's triple B, A, double A, and triple A rated companies, banks, big corporations, that effectively have bonds out there that have floating interest rates. Okay? Again, same situation. Those bonds, as interest rates go up, the interest rate goes up every quarter. So it resets. In that way, you don't lose money if interest rates go up, which is the key. It's a floating rate program. So that fund is probably up about 2.5% this year. So that's something we'll put in a portfolio. So you know what? In the portion of fixed income with what we already have with the Clear Shares Fund, and then you put in the adjustable rate, what we want to do is create a positive return from fixed income where we shouldn't be able to. Everyone else will lose money in fixed income. We'll make money in fixed income by doing that. So that's effectively true. So just make sure they float up so that you don't lose principal as rates go up.
Any other questions?
Yeah, I have a question. I'm looking at your your percentages here, the 1 month, 3 months, the 1 year and the 3 year. If I remember correct, when you were here last year, you were looking at like 3 to 4% increase over the course of a year. Is that correct?
I don't recall, that sounds about right, but I don't know the specific.
Okay. I'm looking at a statement here from State of Rhode Island's pension fund that they have. And the pension fund itself is like, in a 1 year plan, it's got an increase of 8%. 3 year plan is 8.2, 5 year is 7.4. Their target was 7%. Their, in the past year, the portfolio has outperformed its benchmarks, returning 8.0%, while the plan's investment benchmark earned 7.8. What is it that they're doing different, and it's been done here, other than the amount of money they have versus what we have?
And what's the end date? When's the end?
8/31.
Yeah, 8/31. Yeah, so if we went back 8/31, we wouldn't have had that kind of return. It was, I don't remember, we can look it up, what it was as of the end of August. The difference is, a pension fund that large can invest in really areas that we can't invest in, which is more important, private equity. Private equity, venture capital, and things like that, where they're 10-year investments. You can't get your money out for 10 years, okay? Big pension funds like that typically will go there when they want a much higher return and a higher risk kind of profile, okay? There you're shooting for 15% type rates of return or more over time. But your money's locked up for 10 years, okay? So you just cannot get out. In a fund like ours, we can't take that kind of illiquidity risk. So that's really a big difference as well, that what they can do versus what we can do. That's a big difference.
So I wasn't able to bring my August report up on my phone, but the 1 month of September was down 30 basis points. So if you want to just factor that into this number, the 1 year return ending September 30 was 6.4%.
No,
So we were pretty close. We just didn't have the advantages that some of these bigger funds. You know, there is cash flows that occur every month that we have to be cognizant of. We have to keep that handy because we don't necessarily know when cash flows will come in. So we have to keep a higher cash balance in this portfolio.
Okay.
And as Tim mentioned, that private equity, you can't tie your funds up for that amount of time. I mean, there are lockups for 7+ years in a lot of instances.
Albert, what you're going to see is in a lot of the big state and local pension funds today, upwards of about 10 to 20% of their portfolio is in that private equity and whatnot, private investments today. So that makes a huge difference.
You say their risk is higher because it's locked up for 10 years.
Yeah.
When you say higher, is there a percentage, or what's the risk that they're actually taking by locking it up, doing that? Because you're
Well,
talking a lot more money to deal with.
There's really two risks, okay? What ends up happening is, and this happened in 2008, when you have 20% of your money locked up in something where you cannot get out or have any access to that money, when the market goes down 20 or 30%, all of a sudden the other 70% of your portfolio is now down 20, right? So in reality, the amount of assets that you can liquidate immediately goes down as a percentage of the whole portfolio. Because that 20% illiquid stays there. And it's not just a one-time investment. You're making capital contributions on usually a 3 to 5 year time period, and then hopefully you harvest out from 5 to 10, okay? So it's just not an initial investment. You're making investments over 3 to 5 years as well, also. So it's illiquidity risk is number one. Two is, you know, depending on the fund, venture capital and private equity has higher risk in that there are some funds that can go to zero, and they have, okay? So they have the ability to take that kind of risk because they can make money elsewhere and whatnot. It's kind of a balancing act for them.
But the reason I ask, I've been watching this and I look at these, is overall they're doing better on the investment. But I understand they have more money they're investing.
Right.
But if we were to merge with them,
Mhm.
we would have a greater turnout.
Yeah, you could. And the other difference probably is they probably have a higher equity allocation than we do as well. Because what we're trying to do here is two things. It's not just return, because what will make a difference also is the fact that a lot of pension funds that have done better, let's say over a time period, is they had a much higher allocation to stocks, okay? The funds there are certain pension funds that we run that don't mind taking the risk. And the example is, we run the money for a college university in Westchester County in New York, okay? They're ranked number 1 in the country, meaning they've beaten everybody else. The reason is because their stock allocation has been 70 to 75%. But they're not down 1% this month.
Yeah,
I mean,
they're
they're
way
down
down.
substantially.
Way down, right?
They're way down. They're down 4 or
Which-
5%.
If we were allocated like that, we would be down
Yeah.
just as much.
Right, you'll be down just as much,
Right.
okay? So they were willing to take the upside and take that kind of risk. We have always thought within a fund like this, where what we're saying is because of the escalating benefits we're going to be paying over the next several years, and the math just continues, and we all know that, is let's target a 7% rate of return if we can per year on a rolling 3-year, 5-year basis, but not take enough risk where you're going to be down 10 or 15%.
Right.
That's the way we've always looked at it. Those pension funds can be and will be down 10 to 15%. That's the reality of what their asset allocation is, okay?
But in some cases, they can afford to wait.
Yeah, they can afford to wait. They have a 20-year, 30-year time frame. And they can go raise their taxes, and they can do a lot of things that a lot of folks don't have the ability to do.
Well, one other thing that I want to point out, in past meetings when we've talked about the alternatives exposure, we've always positioned it as a bond alternative. So it's sort of a risk reducer more so than a return enhancer. I mean, ultimately, it is going to always, you're ultimately trying to enhance your return over time. But we're not trying to add funds that are going to be really volatile and shooting for a much higher return. We're trying to keep the overall return of the portfolio steady. So that's how we look at alternatives, at least for this portfolio.
Which year to date has paid off. When you look at our fixed income return for year to date, we're basically
fine.
even,
Yeah.
flat, where alternatives were up 3.9%. So obviously that worked.
Yeah, it worked.
Okay.
I have one other question.
Yes, sure.
On the amount of cash you have, it's like 8.8% of the fund.
Thanks for bringing that up. Well, okay, sorry.
Yeah, well, the question I have is, I don't know if you remember this, but when we had Morgan Stanley, we had about $8 million in cash. Okay, so I just wonder, how did you calculate, what went into your calculation relative to cash?
Well, that is what's in the money market. And so we had a flow of 1.89 million on 11/28, 2 days before we printed this. So that was in there. And then on 12/3, 820,000 was taken out.
Okay. So basically, you've got this down to a fine art relative to how much money you're gonna keep in cash?
Well, everybody lets us know how much they need per month. They give us a heads up, and then they'll contribute from time to time.
I mean, some of these other things, I guess you could convert to cash pretty easily, right? Some of these things.
Yeah, virtually everything except for the alternatives, everything outside of the alternatives is daily liquid.
Okay. and
Yeah, if you needed to.
We're paying a price in our investments for doing that because all of those things are in lower interest rates. The things that can be turned into liquid.
No,
No?
not necessarily.
I mean, they're, on the traditional side of the portfolio, it's daily liquid, meaning they're mutual funds. What the state is doing, they probably have some of the similar investments, and I'm sure they have a fair amount that's daily liquid as well. But where the difference is it's called, the jargon is a lockup. They, I'm sure, have investments in there that have a much longer lockup. I mentioned 7 years a few minutes ago. So the longest lockup we have, I think, is Davidson Kempner, and that's 60 days notice with quarterly liquidity. And that's 3.6% of the portfolio, $1.2 million. So it's a very, very liquid portfolio.
Now, can you do full interest and leave principal, or do you have to take out,
We reinvest.
you reinvest?
Yeah, we reinvest. We never take out. We always reinvest in compound.
And in terms of our present prices here, you're not pulling out of our major investments in tech and things of that nature?
Well, what we did do, actually, it's kind of funny, you mentioned, we moved 5% of the portfolio in early October, I think October 5th or something like that, and lowered our overall exposure to tech and growth and moved it into value. We did do that, actually.
Okay, so if that's the case, you don't know whether tech's at bottom at this point, or you're gonna buy back into that?
We didn't go, it wasn't, it was more rebalancing. I mean, we stayed in US equities. We went 7.5%. We cut from the Russell 1000 growth, as Tim mentioned, and then we put it in the Dodge and Cox and the Vanguard 500 index. So the change, let's just say Facebook, for example, is in the growth index, but it's also a top holding in the Vanguard 500 too. So the change isn't as significant as maybe the number,
I'm not sure I understand, but I guess what I'm saying is that since techs have dropped considerably in terms of value, is this a buy opportunity relative to put that 5% back?
Probably not. Well,
You think
because
it's gonna go down more?
I think I think it's gonna go down more at this point in time, to be honest. Yeah, we just think that the whole mentality of the market has changed where we've had a great 8-year, 9-year run in terms of economic growth and growth in terms of the markets, particularly technology in particular. When you start to go down to the other side, the market doesn't pay a premium or a higher price for growth anymore because they're going to decelerate as well. So where do people put their money now? In boring things like healthcare, like boring things like utilities, okay? More stable companies. And that's what we did in October, and we're going to probably continue to rebalance back to what you call growth versus value. We're rebalancing back to essentially value in high quality companies, effectively. So we think that's where the growth is going to be at this point.
So, based on what this Rockland's area show, where what's going out and what's coming in, there's not that much difference. We're not, the small amount that we're making, we're basically just treading water, aren't we?
Factoring in October, yeah.
Yeah.
Before October, no, we were doing pretty well.
And if you see this trend continuing, what's your plan for that?
So what we're doing is, as we said, fixed income side, we're shortening the overall exposure to interest rates. So we've done pretty well. We'll probably do better going forward as we make these other changes. And two is what we're going to do is take out some of the exposure to what did very, very well last year in the beginning of this year, which was small caps and mid caps, did really well. We'll probably lower the exposure there, move to bigger companies like the S&P 500 or whatnot, which are more stable. And we'll probably put in a component in the portfolio that, as we mentioned, more boring companies, higher yielding companies like utilities, et cetera, where they pay a much higher dividend level, 2.5%, 3%, much more stable, try to grind out a return as opposed to more growth, as such as we've gotten in tech and information technology. I think those are the big differences. We're taking down the risk in the portfolio is the best way to put it. Putting in more stable companies, more stable indexes.
So based on the cash flows that we've seen, you're not necessarily taking out of the corpus. There's flows coming in and then you're immediately taking them out. So
Okay.
you're not necessarily losing this,
On there.
right? So with that said, maybe this is a good opportunity. We haven't reviewed the investment policy statement. Probably we're about to. So think about it in the context of those ranges that we set in the investment policy statement. And now that we've gone through some corrections, is it something that we can still sleep at night? Are you comfortable with those? Because that's the bands that we operate within.
And that's the problem, that I think we may be not so comfortable with that. Because I'm looking at the 2014 funding improvement plan, which was supposed to get us out of, make this pension plan healthy by 2040, I think, 2040. And I'm looking at, well, we haven't even got to your charts back here, but your charts are way over what our plan had been, our required, our ARC and our
That may not be us.
percentage of employee contribution as a percentage of the payroll.
That's Nyhart, not Clearbrook, who has those charts.
Oh,
Different
okay,
company, yeah.
okay, I was looking, whose charts are these?
That's
Nyhart.
Oh, okay, sorry.
Yeah, he's gonna
This is just program. Did I do that?
He's the one that's gonna be on the hot seat.
All right, well, Clearbrook was doing all right then.
One,
You know, they were more stable investments, so.
But nonetheless, I mean, if that is a concern, it still relates to the investment policy statement.
Yeah.
And are you comfortable with those ranges? It's sort of, can you sleep at night? So if it's 2040, there's other issues that you have to figure out, but that's still a fairly long-term
Right.
portfolio.
Could you tell us, what's the fees that you charging us? The fees?
30 basis points per year?
Is it a certain percentage of the net asset value? Or
Yeah,
Yes.
it's 0.3%,
Point
0.3 per year.
of the net, is there anything beyond that, like
Nope.
a percentage of the return or the?
No, nothing, just 0.3.
The underlying mutual funds have expenses.
Right.
Right, but one of the things that's beneficial about an OCIO portfolio is that in certain instances, some clients don't qualify for the institutional share class, but we bring the leverage of the other clients in and allow you to get into those cheaper funds.
So in reality, it's a big savings, because if you went to a mutual fund complex like a Dodge and Cox, a Fidelity and whatnot, a lot of these funds will charge you typically, let's say 25 basis points, 70, 80 basis points. What we say to these complexes, like a Vanguard, for example, hey, we have X amount of dollars across all of our clients. We want the lowest fee share class that you're charging everybody. So instead of being charged, and we've had clients, for example, you go buy an S&P 500 Vanguard, times they'll charge you 25 basis points or 0.25%. We're paying 4. So that's how we try to make up in terms of aggregating all of our clients together and negotiating with the investment managers on your behalf. So we save a lot of money doing that.
You got a question?
No, no, you've answered my questions.
Any other questions?
Anyone out there have a question from the audience?
Thank you.
Thank you very much.
Thanks, everyone.
Thanks, guys.
Merry Christmas, everyone.
Merry
Happy
Christmas.
holidays.
Thank you.
Take care.
Thank you for coming.
Right?
Go ahead, sir.
Oh, no, I was waiting to be called in.
Does everyone have a copy? Looks like you all do. Does everyone have a copy back here, or those who want it anyway?
Now I have,
Okay, great.
talk about this.
Yep, that's the one, right there, the colored one.
Yeah.
Well, thank you for having me. My name is Carter Angel. I've been with Nyhart for a little over 10 years now. I work on all of the clients that we have in Rhode Island. I lead our Indianapolis pension department, and I'm a principal of the firm. I think you all probably are familiar with Tate Odom. He's still with Nyhart and still works with pension clients every once in a while, but I just am sort of replacing him, I guess, for lack of a better term. And he would have came out tonight, but he had some family matters to attend to, so he stayed back. But anyway, like I said, I've been working with Rhode Island clients since 2011, and your plan directly now just a little over a year, I suppose. But we'll start on page 3, if that's okay. Just a real high-level overview. Nyhart Services, we're a full employee benefits consulting firm. We work on the pension plan for you guys. We do OPEB, retiree healthcare. If there's ever any need for us to do further administration things with the pension plan, we do that for some public plans and most of our private plans in general. Looking at the next slide, Votaire. So from an employee financial wellness standpoint, this is an in-house tool that we developed. It's meant not only to help employees accumulate assets, but also decumulate as well. I think one of the things that sets it apart from other tools is local health care costs. It actually calculates what those would be for someone living in like Rhode Island, and it compiles all employee benefits. So this is something we demo for Tracy or whoever. Again, it'd be for the employees to use as a tool to help them plan for retirement. Looking at page 5 now, just from a highlights perspective, if you only wanted to look at one page in the management summary here, this would be the page to do so. The changes since the last year, from an asset return perspective, and this is a measure from July 1 of 2017 to June 30th of 2018. And so comparing to the gentleman's numbers who just left, it may be slightly different because we have a pretty basic return calculation, but we calculated the return to be 6.9%. We're expecting 7.5%, so a little bit lower than expected, about $200,000 lower if you're just looking at a 1-year snapshot. We did update this mortality improvement scale. A few years ago we made a big update to the mortality assumption that increased the liabilities quite a bit. This is a minor thing we've been doing every year. For the most part, it's actually been decreasing the liabilities, and that's what happened again this year as well. So the net effect of those two things was essentially a wash. Assets earned a little less than expected, but from a liabilities perspective, they didn't grow quite as much as we expected either. Recommended contribution now for the fiscal year ending 2020, so to be made from July 1 of 19 to June 30th of 2020, is essentially $10 million.
So that's a big, I'm looking again at this 2014
Sure.
funding improvement plan.
Sure, and I apologize, I don't have it in front of me, but I can
Yeah.
take a look if you'd like.
Well, it's a lot more than what we were anticipating for 2020. It's about $600,000 more than what we were anticipating for 2020.
Sure.
And, like you said, our growth is less, but so is, the assumption was that, the inflation rate would be 3%. And from 2015 to 2018, the inflation rate's about 2.5%. So.
Inflation generally, are you talking about in
The overall inflation rate for the U.S.
the economy of the U.S.? Yeah.
So, so that should have been working in our favor here.
Well, I mean, depends on what's actually occurred in Rhode Island. I mean, in West Warwick. I mean, if the U.S. population inflation is 1%, but it's 4% here, I mean, the liabilities are still going to grow more
And
here.
not really seeing that we're all that much different here than anyplace else. But-
Sure. Well, from an asset return perspective, so from 2014 to for the last 4 years, the last 4 returns have been going backwards now. 6.9%, so lower than expected. 12.1%, up higher than expected. Then a negative 3.6% and 1.4%. So that is.
Overall,
I'm sorry.
yeah, your bucket calculator.
I was say I'm going to tell you what that is. So that's a 4% average for the last 4 years, and we're expecting 7.5%. So I can't tell you the breakdown from what we were projecting 4 years ago to now, but that certainly plays a role in the ARC now being higher than projected, because 4 years ago we expected you to earn 7.5% for 4 years, and you only got 4. So that's certainly going to cause an increase. Now, how much of that is attributable to the 600,000, I couldn't tell you right now. We could figure it out if you'd like us to, but that would be a exercise for another day.
All right, so, overall increase has been 4% over the last 4 years.
Mm-hmm.
And that's really gonna affect our ARC, which means it affects the town budget a lot.
Sure.
if that 10 million's not met.
If the 10 million's not met, is that a question? Minor,
Yeah, in other words, obviously, if it's not met, it's gonna affect it, but, to make the following year, whatever the amount is plus that difference?
to an extent, yes.
So I'm kind of thinking that we ought to maybe take a look about having add more risk. 'Cause I think that if we don't do something now, soon, well, we're gonna be in real trouble in about 5 years. So, if we continue to grow at 4% or less, we're not doing, we're gonna have trouble.
Question?
You know, in a year when the stock market was earning like, was up like 25-28%, we got 12. And we weren't supposed to be really losing that much, but we lost 3.6 one year.
Yeah, I mean, can't foresee everything, but,
No, you can't.
just
And
that
I mean,
10
that's the
million,
stock market.
it's a big chunk to bite in 1 year.
Yeah, and I'm certainly not at all meaning to paint the asset performance negatively. I was just referencing your question there. But, if you look at the past, well, I don't want to exclude '08, but if you look at the past 10 years, that would include '08. The plan earned 4.7%, which is probably pretty common for plans when you include '08. Most plans, it's going to be somewhere in that range, certainly lower than expected. Now, if you take '08 out, not necessarily trying to cherry pick it all, but the plan's return is 7.3%. So, like I said, the 7.3 over those 9 years has been, it's 0.2% lower than the 7.5, obviously, but it's been pretty good. So, like I said, I wasn't trying to paint those last 4 years as negative or anything. That's just what it is since that FIP question.
Well, and the other thing, as you pointed out, this asset return of 6.9% ended in July.
Mm-hmm.
We've kind of been going down. October, November, December has been,
Yeah,
the market's been going
I'm
down.
certain.
So we probably lost a bunch of that.
But if we were riskier, we would have lost even more,
Mm-hmm.
Not necessarily. Kind of depends on where you're putting your risk.
Well, yeah, that's
So,
like the gentleman in Clearbook, that's all they do day and out, so they figure which one is the less of a risk, if you're gonna take a risk.
well, I guess what I'm trying to tell you is that over the last 4 years, they haven't met the 7.5% that we were planning on. So we're considerably less than that. That's an issue.
So you're saying 2008 really took a hit on everything,
Everybody did.
Well, yeah, that was,
All right.
that was a tough year.
but from '09 to now, what's the number? come
If you look at the last 9 fiscal years, from 09-10 to 17-18, the plans averaged 7.3%.
What was 08's percentage?
From 08 to 09, it was minus 15.7%. You guys
So
had two.
We're still behind the 8 ball, even though,
That was the year we had a
Yeah.
huge financial collapse.
Right.
you know.
but I'm just saying, for what we lost there, we picked up some, but we're still behind the 8 ball.
Yeah, when you look at the 10 years since then, yeah, it's 4.7%.
Yeah.
Expecting 7.5. Yep.
I'm wondering how you plan, okay.
Well, all right.
Yeah.
We can talk about this some other time, but this is definitely concerning, and it's,
Can I make a comment?
yeah.
Just a thought, I know what you're wrestling with here in terms of, should you go accept more risk in terms of protecting it. Obviously, the people doing the investment for you are heading towards protecting your resources, right? They're moving the money out of the tech into other things.
Right.
I'll make this, I made it the last meeting too, I think what you're lacking is more information, another opinion, it's certainly not me, but I'd get a financial advisor in addition to the people you're gonna invest in the money, and try to get another opinion on how you would allocate your money. It made a hell of a lot of sense to me tonight, listening to them in terms of talking about risk. You would have been down a lot more had they not moved the money.
Right.
And I was happy to hear that you're still at the $34 million range, even though in June, you were at 38 million based on what the actuaries got here. Okay, so you're talking like a $4 million drop from to now, but it
Yeah.
would have been,
Worse.
it
Oh,
would
yeah.
have been dramatic.
Because I've asked those gentlemen a question before about that, when did they make the decision, and who, do they have the authority to do it? And it's, yeah, they have to, basically a blanket.
But you people decide the investment policy. I'm just saying, a
Right.
financial advisor, even on an interim basis, you don't have to accept it, but you get a different opinion.
Right.
Somebody who's educated in this field in addition to the people you have. Not to say that what they're recommending isn't something you should do.
Right.
Okay, but what you lack here is you just can't, there's too many people depending upon this fund to just guess at it.
Right.
And I'd be guessing. You know, I'm over here talking to you, basically, I assume that tech is the future. And I'm thinking if you invested in tech at the bottom of this market, you'd make a lot more money. But their argument made sense to me in terms of trying to protect your asset. You're not, $8-9 billion fund where you can take that kind of risk. So I think you need more information.
Okay. Yeah.
Okay.
Well, being in a balanced fund, that's why you don't have the 25% return we saw in the
Right.
stock market.
Yes.
If we were 100%
I understand
invested
that.
in the stock market, we would have had like a 24% return, but
Right.
today we'd be saying, oh geez, we probably shouldn't have done that.
Right.
Because we don't have that kind of assets in the plan. Has anyone up there had any conversation with the state treasurer?
No, we just have some.
There is legislation,
some-
and I'm gonna say this again,
Yep.
State House. Okay, I have copies of it, if anybody would like it, I can give them to Tracy. I think it's languished for at least 1 year now, where it is specifically aimed at distressed communities. And as part of what our retiree group was told, part of that could be where the state could manage our fund at very least. Even if we didn't join the system, they could manage our fund for us at a much smaller rate probably because of the amount of money they have invested. Plus, it would open us to other markets like the previous gentleman were talking about. I think we're remiss by the second opinion that John's talking about. That's probably a guy we should probably talk to. He's very involved in this. He understands this problem. And maybe, I'm sure he'd come down and talk to you because he came down and talked to retiree coalitions.
Yeah, I remember, I was at the meeting,
So-
and one of the things he talked about, when we talked about at the meetings, was the guarantee the ARP too, which is something, especially when you start looking at 10 million, there's no guarantee that we're gonna get 10 million.
No, there's no guarantee to that, and the ARC, I think we've all, nobody's been saying it's not gonna get worse before it gets better. Everybody knew that
Right.
from the get-go, that it's gonna go to 18 million or wherever it's going, and that, therein lies the problem. And this is why the legislation, I think some people are shy from it because they think it automatically puts you into the plan, into the state plan. It doesn't automatically do anything. It just gives distressed communities another option if they run into a problem. Now, distressed communities still have to maintain their own liability to their plans, but that's the major question mark as to how that liability is gonna be calculated. If it's a reasonable number that can be bonded out for a number of years, and we're totally out of the pension business, and the state takes over the pension system, because obviously the teachers are already in the state pension system. It's just the municipal side of the government that is not. If it's a reasonable number, it could be something that could be looked at as a bond to get us just totally out of the pension business altogether. I just think he'd be a good asset to speak with. I mean, I think if you called him, maybe set up a meeting with him, he can tell you what their plan's doing. He can tell you what you should be looking at maybe for a return on our plan. I mean, if we're looking for 7.5%, it's actually, I don't think you can really count 08 because 08 just everybody got
Everybody
destroyed. Our
got
own
hit, right.
personal accounts got destroyed in '08, no matter what financial advisor you had. So it is returning 7.5%, but can we do better in their markets that they would open for us? That's a question I think needs to be asked. We've got to start thinking a little bit outside the box if we're gonna get this out of the issues we got.
Okay. Can you gotta continue?
Sure, yeah, of course, yeah,
Go ahead.
whenever.
No, go ahead. I don't wanna hold you up.
No, I'm here till whenever. Real quick, still on the highlights page, the funding percentage did increase from 21.8%, excuse me, to 23.3%. One of the primary reasons for that is because the ARC was made. I mean, as long as the ARC keeps being made, that funded contribution, for the most part, will trend upwards. Depending if we have a bad asset year, it may not, but again, long term, it will continue to trend upward. Same thing, long term now I understand there's other questions with the sustainability of making the large contributions, but if they do continue to be made, this plan will, again, trend upwards and become much better funded. There is a possible update to the mortality assumption coming in the next 1 to 3 years. So what happened 4 years ago, I guess roughly, was the Society of Actuaries released this study, and that study was comprised primarily of data from private entities or private companies. It did not really include public plan data. They are working on a study that is only public plan data now, and we would expect that to come out in the next 1 to 3 years. I think there would be time to review that and everything, but we would probably at some point, I would imagine, recommend that mortality assumption be made to be used for this plan, since this is a public plan. What that will do to the liabilities, I don't know, because I don't know what the public plan mortality has been, but just wanted to make you aware that that is a possibility that would come out. This change that we made this year, this mortality improvement scale, I mentioned it decreased liabilities by $200,000. That's like 5 basis points. It's super small on the plan liabilities. This change would probably not be small one way or the other. It probably could go decrease liabilities 2%, or it might increase liabilities 2%. It's hard to say. But just an update that could come.
So once that comes out, you're gonna need another year or two.
Well, yeah, just depending on when it comes out. I mean, when the Society of Actuaries first released theirs in 2014, they released this improvement scale that a lot of professional organizations thought was too conservative. It said people were going to start living a lot longer.
Right.
And we balked at it, and so did others, and we used a different scale. And ever since then, the scale they released has trended towards what we're using, essentially. We use assumptions from like the Social Security database. And so, yeah, I'm not sure it would take a full year, certainly, but just depending on the timing of when it's released may not go into effect for this plan.
I'm just afraid of kind of totally switching, like 1 year we're doing this scale, and next year, bam, we're into another one. Would you kind of stagger that if it's a dramatic difference?
I'm not sure you'd stagger the scale. What you could do is just sort of integrate it from the contribution of the ARC, for instance. We would calculate, let's say, the old way, I'll call it,
Yeah,
and then we'd calculate the new way, but then we would smooth into it,
Yeah,
like
okay.
over 3 years or something, probably not any more than that. But the liabilities that we would show would reflect the total new scale.
Okay.
So we've done that before when we change big assumptions.
Yep.
So. Looking at page 7, so the funded status of the plans. So I'll try not to use colors. For those of you that don't have colors, I apologize. But the big bar there, that's the liability of the plan, the accrued liability. That's just the liabilities of the plan that people have earned. The middle bar there is the market value of assets. So about $37.6 million again at July 1 of 2008. The liability was about $165.6 million. And then the plan assets, the bottom row or the far right bar, bottom line in the chart there is $38.6 million. The difference in those two, the market value of assets is exactly what it sounds like. It's sort of what you had in the bank, if you will, there at June 30th. That plan assets is a smooth number. So we take the past 5 years of gains and losses, plus or minus, good or bad, and we just smooth them in over 5 years. So we don't take the full brunt of any bad years right away, and we don't take the full good of any good years right away. So that's why there's a little bit of a difference there. Okay? So bottom line there, then again, plans funded at about 23.3%. An increase of 6.2% over the last 5 years. Okay. When we do our calculations for the ARC, we always use the plan assets number. We use that smooth asset number.
Okay.
All right. The market value is lower than the plan assets right now. So what that means is the market value of assets have actually underperformed a little bit from from what we would expect, which again goes to what we just talked about with the 4% earnings over the last 4 years. The contribution recommendation on page 8. So the far right bar is again for the upcoming fiscal year ending in 2020. The top portion there is the interest portion, just to account for the timing of when it gets made versus when we calculate it. The middle section there is what's called it's the cost of benefits, essentially, that is being earned by participants, but just the employer portion of it, and that's about 4.5% of pay. And then the amortization of the unfunded liability is about 52% of pay, and that's the big bottom bar in the chart there on the top. Total ARC is 59% of pay, with a projected payroll for that fiscal year ending in 1920 of about almost 17 million. So the recommended contribution is a little over $10 million there. That is an increase from 9.6 the last year, and then 9.257. The contribution as a percentage of pay should stay relatively flat over the years. Now, it won't, because payroll will not grow as expected, but that's what it's designed to be. The way we take the shortfall again of whatever it is, we amortize that unfunded liability. We set a schedule to pay that off over so many years, but it's designed to grow with payroll. Okay, so as a dollar amount, it's always going to keep going up. As a percentage of payroll, it should stay relatively flat. Now, what happened from, if you look at the 17-18 charges, the 9.257 to the 9.6, you can see it jumped from 56% of pay to 58.9% of pay. Payroll didn't grow like we expected there. Payroll actually shrunk. So that's why that contribution grew as a percentage of pay. But that ARC, for the most part, should stay on a pretty steady trend upwards as a dollar amount. As a percent of pay, it's designed to be level with minor fluctuations here or there.
As you said, that as soon as the payroll goes up, and in fact, the 2014 plan actually had the percent of the contribution as the percent of pay going up to 67%.
Mm-hmm.
Okay, up to in the year 2039 or
long time from now, right?
Yes,
Yep.
it'll be up to 67%. Okay, so it is expected to increase. That was to make us financially stable.
On page 9 is just the contribution recommendation, broken down by division. The chart, or the bar charts in the top, follow the same order as what's down below. So the police is on the top, followed by fire on the way down to the library, and those just sum up to the total of the $10 million there. On page 10, participant information. Again, historical view, but most recently, the top chart is there's this disabled participants in the plan. There's 58 of them. That's held pretty steady over the last 5 years. The next section down is for retirees and beneficiaries. There's about 290, slight increase from the 277 that were there 5 years ago. Next section is what's called deferred vesteds. These are former employees who've left the town, but are still due some form of benefit, either a monthly benefit at retirement eligibility age or just a return of their employee contributions. There's 37 of those. And then there are 321 active employees in the plan. Again, that's a snapshot at June 30th of 2018. Okay. Demographic-wise, the average age has increased a little bit, but the average service has stayed relatively flat. Payroll has grown, both as a total and then as an average over the past 5 years.
So right now, there are more people receiving benefits than there are contributing to the benefits. Is that right?
That's correct. 348 to 321. That in and of itself is not a problem necessarily, nor is the fact that more money goes out of the plan than comes into the plan. That's not necessarily a problem. That happens with plans that are 100% funded versus 22% funded or whatever. The problem with that is, though, is you are leveraged very much so, and your asset return is super important. So when you don't get your asset return, it can sort of significantly impact the funded percentage of the plan pretty quickly again, because you do have more money going out than coming in, so you're depending on that asset return to make up for that. So that is the risk that is there. Again, money going out more than coming in is, again, not necessarily a bad thing. It just means the risk profile of the plan is different.
You're saying, in the right chart there, there's 290 retirees in the system
And beneficiaries.
and beneficiaries,
Yes, sir.
and 321 active that are participating in the plan as far as putting into it.
Mm-hmm.
Okay, so we do have more
No.
putting,
Well, the 58 on top are
Yeah, the
disabled
58
participants,
58,
and
okay.
they're receiving as
37.
well.
all right.
There's people
Then
that-
the 37, is that count the ones also that have just pulled their money out or no?
No, these are people who still are due money, either a
Okay.
return of their employee contributions or
Right.
some sort of monthly benefit at
Okay.
retirement age.
All right.
But they're no
okay.
longer contributing to the plan.
Right,
That's
okay,
correct.
all right.
Page 11, I made a note, I think we share with the asset advisors, annually a projected benefit payment stream, but this is a historical view at what benefit payments have been the last, 6 years, and then compared with where we think they are going. There's a little bump there up in 19. Usually there's a lot of people eligible for retirement age that we assume retire because they're eligible to fully retire. Not everyone does that, so you always see a little bit of bump in that next year, and it sort of levels out there. But again, we would expect that to continue to increase, both with as COLAs kick in again, and then just general more retirements, et cetera. To the point we were just making about the plan, the counts, if you will, and the more money coming out of the plan, or getting close to that point maybe than coming in. This is a breakdown of the liability by participant group. So actives are the $48.4 million number. It's about 29%. And then the rest is made up of essentially inactive employees, people who no longer work for the town. So 71% of the liabilities is tied to people who no longer work here, which again just changes the risk profile of the plan. Looking at page 13 now, so the normal cost percentage, I should change the header of the slide because it's a terrible actuarial term. That's just the cost of benefits being earned by participants on a given annual basis, okay, as a percentage of pay. So as of July 1 of 2018, the total normal cost percentage there below the chart says 15.63%. So when we do our calculations, we say participants on average earn benefits that cost 15.6% of pay, okay. But the employees on average pay for 11% of it. The employer on average pays for 4.5%. And again, that 4.5% is the same 4.5% that I referenced on page 4, whatever it was, as part of the ARC. Okay. On page 14, again, this is a very simple breakdown of the asset reconciliation. I would imagine the beginning and ending numbers should match the gentleman from Clearbook, but they may be off slightly. But at July 1 of 17, just looking at the market value of assets line, there was about $33.7 million. $9.7 million in benefits were paid. $9.2 million came in from the employer. A little more than $2 million came in from the employee, a total of $11.3 million. So there was still a $1.7 million greater amount of money going into the plan than coming out of the plan. And again, I don't have it in front of me, but I would expect sort of the contributions coming in would still probably outdo the benefits, just because the contribution recommendation is going to go up as a dollar amount as well. So are the benefits paid, excuse me. So without seeing, I apologize, I don't have the most recent FIP projection in front of me, but I would expect that there to still be a gap, at least a little while, where more goes in than comes out. But anyway, expenses of $260,000, and then an investment return, again, by the simple way that we calculate it, of $2.5 million gets you, again, at 6/30/18, about $37.6 million in market value of assets. All right. Any questions? We hit on this slide earlier, but again, last 10 years, average return has been 4.7%. We're expecting 7.5%, so that is a sizable amount that has not come into the plan from returns. That does then go directly to into the ARC, if you will, increases that ARC. Page 16 is just a breakdown of the assets by the asset class. 19% are in alternatives, 4% is in cash, 18% is in fixed income, and then 59% is in equities. Again, based on the breakdown we received, I think, when we did the GASB. Speaking of the GASB, so the GASB, as you probably all know, is for the accounting that you'll have to record for the town. So page 18 is for the accounting expense. It's comprised of a lot of different components: the cost of benefits, the interest growth on the liabilities, what do we expect assets to earn, employee contributions are come out, and then there's always this recognition of deferred outflows and inflows, which essentially is a recognition of the difference between what actually occurred versus what we expected to occur in a few different categories: asset growth, changes in assumptions, and or demographic experience. In total, though, from an accounting perspective, the expense on the books for the fiscal year ending 6/30/18 is $11.2 million.
Can I ask you a question?
Yes.
Why did the administrative expenses go up so much from 17 to 18?
That was really a timing thing, I believe, in terms of what was allocated to what year, if I'm remembering correctly. But I'd have to go back and look to give you a full answer, which I can gladly do and share with the pension board. But from an administrative expense, I'm not. I imagine that would include actuarial fees to NIHART, trustee fees, custodial fees, and then that's probably about it. But I know our fees didn't go up that much, and like I said, it's probably just a timing thing. But I'd have to go back and look to give you an exact breakdown.
Can you give them a breakdown of the administrative expenses?
Do what?
The pension board, do you give them a breakdown of the administrative expenses, or you just figured what they are?
Is it figured in the article?
Yes. You just went through your fee, your fees. Do you give the pension board a breakdown of all the administrative fees? Secretary, lawyer, anything else?
Do I give that to him? No. They usually ask for it.
They never asked for them?
So I can
They
share
have
it.
no idea what the administrative costs are for the lawyer?
Oh, I wouldn't say that. I'm sure they know what they are, but
Well, I'd ask them. Just give them an answer yet.
Yeah, it's confidential.
So I was hoping that you could give it to me, because they rely on you for all their information, so I figured you would have a breakdown of what the administrative expenses were for every category.
I have a breakdown of what the fees were for this year, but I look to the pension board to I mean, I can, they want me to share it, I can, I mean, that's,
Sure.
I mean, if
We've
you keep
shared-
it confidential, keep it confidential.
I don't know,
Maybe you can share it with the town council.
It's a public record.
So
We've
the
shared it
expense,
before, it's not something that
Yeah.
we haven't shared with you before, so. If you'd like to give them the breakdown, I'm happy.
I just,
no, go ahead.
it doesn't matter to me. For the period ending 6/30/18, $60,000 was paid to NIHART, $41,000 was paid to Olin and Penza, about $5,000 to fees to the town, and then about $2,200 in medical fees is what we counted as administrative expenses. Now again, I don't have what it was for the year prior, so I can't help you out there as of right now.
You have the
But
total in here, though, right?
we'll have the total, but I don't have the breakdown. Like I said, I know some years with all public plans we work with all private plans we work with, the breakdown of fees that we get always varies, if you will, in terms of how it's presented to us. Some years they change banks, et cetera. Sometimes they change the allocation of where those expenses go, or the labeling gets better or it gets worse. So my point is, I wouldn't, off the top of my head, I'd be surprised if actual administrative expenses, if you did an apples to apples from year to year, I would be surprised if it went from 68 to 108, I guess is my point. But I'd have to go look to verify that.
Maybe you could share it with them, and then at the next meeting, they can give it to us.
Get that.
Looks like it was kind of a wash though between the service cost and the admin expenses. When you add them both up, it looks like it's about a wash. So.
Okay. I can talk to Tracy about that and figure out what we want to do.
I don't understand understand on page 18. The interest on the TPL, is that a positive number, 11.11 million?
Yeah, so that's just the growth in liabilities from one year to the next. We, like we expect the assets to grow 7.5%, we expect the liabilities to grow 7.5% as well, essentially.
This is growth in liabilities.
Yes.
And then the expense is, what exactly is expense?
Oh, the ending number?
Yes.
So that would be, from an accounting perspective, again, that would be what should go, I think, on the income statement for you guys from an accounting perspective, or from the town's perspective. I say you guys, I apologize. From the town's perspective, $11.2 million in expense. It's just an account. I don't know what I mean. It is an accounting figure. So there's no cash consequences of that number explicitly.
Is it the sum of all of the numbers between 11?
Yes, it is the sum of
Okay.
those components. Yes.
That's what I was looking for.
Yep. Sorry. And on the next page, again, still looking at GASB accounting results. These are as of June 30th of 2018. But due to the way we have to derive, or the way we calculate them and the timing of them, the liability number here, this net pension liability 165,165, is real close to what we talked about earlier on the funding side, but they're slightly different due to just the timing of when we actually calculate the figures. But it's a similar story. They usually need GASB results sooner than the funding, so we calculate them slightly differently. Lastly, from a projection standpoint, looking at page 21, so we just took the plan as it stands today, projected it out over the next 25, 30 years, said, okay, what if assets earn 7.5%? What if they earn 6.5% every year? And then what if they earn 8.5% every year? Looking at the chart now and the numbers at the bottom, so that top section there, that's what would occur if assets earn 6.5% every year. So if we thought we were in an environment where that's what was going to occur over the next 30 years, we would expect the town to pay $322 million. If we earn the 7.5%, it'd be about $296 million. And if you earn 8.5%, it's $267 million. Just to give you an idea again of what happens. We know not every year you're going to earn 7.5 or 7.5. We know that's not going to occur. But if we're worried about that assumption being too high or something like that, or we may actually earn less than that, there's sort of a picture of what it could look like.
Well, maybe we ought to take a look at 4%, because that's what we've been earning. Maybe we ought to run a chart at 4%.
That is certainly a possibility. In doing that, the liabilities that we measure would be significantly higher, though.
Mm-hmm. And take a look at the year 2040. Recommended contribution as a percent of pay, 96%. And as I said, in our 2014 plan, we never got higher than 67% as a recommended contribution as a percent of pay.
Sure, and that reason
That's
is
a huge difference. That's like a third.
yeah. That 2014 assumes assets earn 7.5%. That we're looking at as if they earn 6.5%.
So we're paying for that.
Yeah.
But we're only we're not even earning that 6.5%. That's my point. So
Sure.
So these figures could be
The projections.
worse, a lot worse, yeah.
They could be, certainly, yeah. But, looking at those, like I said, you look at the last 4 years, that's just 4%. You look at the last 10 years, it's 4.7%. You look at the last 9 years, it's 7.3%. I mean, long term, I think most asset advisors would tell you you're going to earn, 6.5%, 7%, whatever. I don't want to speak for them. But long term, I mean, if you pick out any obviously short-term period, you could find bad returns or good returns for a year.
Yeah.
It just depends.
I just have a question as to why 2020 we're starting with an arc at 9.6 basically when we're already 2018 to 2019 looking at 10 million. Why is that starting low in 2020? We're not expected to have a smaller arc, I would imagine, in 2020. Is this like an old projection or?
No, it's not an old projection. It's just a timing of what we show on the chart versus what we've got up in the beginning there, though. Yeah, that's all it is. Just difference with interest probably, because it. Yeah, it is not an old chart though.
Okay.
So if you come back next year, that 2020 thing could be a lower number.
No, he's already telling us it's gonna be 10 million.
Well, that's my point. If we're at 10 million now, is a year gonna make a difference where that's gonna stay at 96, or is it gonna be more?
No, so the arc for the period ending June 30th of 2020 is $10.0 million, and then the arc for the fiscal year we're in right now, ending June 30th of 2019, that is 9.620720.
Why is it lower?
I think it's just a timing thing of what we're showing in the chart. Just looking at the breakdown differently. It probably doesn't have interest in it the same way it does when we do the actual arc, just given it being a projection is all.
Okay.
Yeah.
I guess my concern here is that, this 2014 plan that I keep referring to, had a chart in it that estimated our contribution as a percent of pay if we did not implement all of the changes that we had done in 2014, where our retirees basically got no raise for 5 years. And honestly, and then it had a chart in it that, implemented all of the changes that we made in 2014, and that's the chart that we've been trying to go by. And what I'm looking at here looks the same as if we had not implemented the changes that we made in 2014. I mean, this chart looks like as if we had never made those changes.
Sure.
But we did make the changes, and we were expecting a better outcome because of those changes, and we're not getting it.
And unfortunately, that'd probably be a lot worse if you didn't make those changes. And like I said, this is not at all a comment on the asset advisors that were just here, but the assets earned 4% for the last 4 years. Again, expecting to earn 7.5%. So that's a significant difference.
Right.
In what was expected versus what was actually earned. From a assumption perspective, I don't, off the top of my head, if that's the July 1 of 14 FIP, I would have imagined that some assumption changes were made in there as well. I think the mortality was probably first implemented in July 1 of 15, and that was a significant increase in liabilities as well that was not built into that. That again would make that projection harder to achieve as well. I mean, that was probably a 2 to 3% increase in liabilities when we did that in July of 15. Off the top of my head, there are probably not any other major assumption changes, but those certainly play an impact there. I think the discount rate's probably been at 7.5. I think for a while.
Yes.
Yeah.
It was, I believe, 8.5%, but that was
Long time ago.
yeah,
Right?
7 or 8 years ago.
Yeah.
They reduced it.
Prior to 14, I guess. Right. Yeah. So there's I mean two big things working against that FIP even after the changes were made to all the parties involved. Again, assets just didn't earn what was expected in that FIP. And that FIP we always assume every year is exactly stock 7.5%. And then again, the mortality assumption was a big change.
Your comments on the projections here, that sheet there, that page before, which is page 20, explains a lot of it too, and some of what you're just saying. Projections are based on a lot of things that are variables that can change, and shouldn't be relied on totally.
Yeah, absolutely. These projections, I mean, silly, I've heard Tate say it, and I always laughed when he would say it, especially in public forums, but these projections are wrong. I know that. They're not gonna be right. You're not gonna earn 7.5%. People aren't gonna die like we expect. People aren't gonna earn pay like we expect. But it's the best assumptions we have to go on, and the general trend of them is what should be paid attention to. We could look in the next 3 years, it's possible we earn 20%, 20%, 20% for the next 3 years, and you'd say, oh, it's,
That's not what Clearbrook was saying.
well, I'm just saying it's possible, and then the FIP all of a sudden looks
Yeah.
much,
I'd like to
much
know,
better, so.
I'd like to know what Nyhart what can do to help us get back on track
What-
with the 2014 plan.
what we can do to help you get back on track?
Yep, I wanna hear some recommendations, you don't have to give them to me tonight,
Sure.
but
Okay.
what are we gonna do to get back on track with the 2014 plan?
Okay. To your question, well, everyone's question, the 9673, I just looked, in our report, we calculated that, that's before, like, we projected a year forward, so it's just a timing thing, I don't know if you have the Val report, but I can show you.
Yeah.
It's just, it should be 10 million in the back, but it's the same basis number.
Gotcha.
Yeah. Are there any other questions?
Um, Have none. You? No other questions? No, sir. Thank
All
you
right.
very much for.
Well,
Thank you.
Thank you very much, thank you for having me. Plus, sure.
Tracy, can you make sure that that the meeting minutes,
Thank you.
Carter Angel.
Dave, nice to meet you.
Dave, nice to meet you, Dave. Oh, yeah.
Thank you.
Here, do you mind if I borrow this? Just evaluation. Oh, it's man.
You have to have it in your email.
Yeah.
I just love the presentation to make it easier.
Yeah. Yeah, so that's at 9673. So this is like
So it's
as
as of July 1 before.
this is
you
like
did-
as of today,
Yeah.
before we projected a year.
Actually-
we should have shown that number. That's
Even like,
Probably in there somewhere, right?
yeah, the
the
10 million number.
certification even says like 7/1/2018,
Yeah.
so obviously you didn't have this at that time.
Yeah.
So it makes
Anyway.
sense. Yep, thank you.
Thank you for having me.
Thank you.
Yes, sir.
Thank you very much.
thank you, sir.
Thank you.
Thank you.
Thank you.
And that's the cost of some water.
Tracy, you need anything else before I go, or?
I'm good, thank you, very nice.
For the board?
Yeah, no, it's a little bit too much. Tracy?
Yes.
Make sure the meeting minutes reflect that I asked Nyhart to tell us, to give us a plan to get us back on track.
Okay. All right, next thing is applications to receive Michael Clark from the police, deferred and vested.
Motion to receive item K1.
Second. Second the motion to
Mo-
receive item K1.
Motion made and seconded to receive application, item K1, Michael Clark. All in favor?
All right,
Right.
Opposed?
Can I just ask a
Go ahead.
question? Is it okay for me to audit his figures like I did for Patrick, so he'll know?
Yes.
And just leave him there, because he's the same?
Yeah,
That's
issue,
what
no
we
problem.
wanted, okay.
Motion made and carried. Item L is Ed Mar. And the numbers are in, he has been given the numbers, he hasn't signed off on yet, so we're gonna table that till next month.
motion to table item L.
Second the motion to table item L.
Motion made, seconded, table item L, all in favor?
Aye.
Opposed? Motion carries. Okay, item M, Patrick Kelly, this, the same thing, we have got the figures, there was a question that was, he's got the figures, he's okay with it, we just need to approve.
So I make a motion that we approve, we have a.
Full motion
I'm
and
Mr.
second.
Kelly's attorney, I just wanted to come here to monitor. Good evening.
Okay. Go ahead.
I know, I'm fine with what you suggested. I was just asked that Ms. Schmitz or somebody send me a copy of the final figures.
I think I did.
Oh, is it confirmed? Whatever you sent, is it confirmed? Is that the?
Yeah, that's the one Patrick, but I'll resend it just to make sure.
Yeah, that's fine. I
Yeah,
trust you.
Sure.
All right, thank you all.
Thank you.
Thank
We all set then?
Yeah.
All right, thanks.
So I'd like to make a motion that we approve Patrick Kelly's application and return figures. His pension.
Second.
And we thank
We
him
do-
very much for his service.
We do have, the amount if you wanna read it. If he needs a copy right now, we can.
Oh,
it's
Sir?
right here.
Sir, do you need a copy of the amount, his figures?
If it's what Tracy had sent me previously.
Just, yeah, before we approve.
I could send it to you, but this one's just written on a little bit, but if you want me to get. in Patrick-
That's what we thought, yeah. that's-
Yeah.
Can I hang on this?
Yeah, sure.
Beautiful. Thank you all for your cooperation. I
Thank
So I don't
appreciate
need
it.
to send it to you?
No, this is good. All right.
Okay.
Have a happy holiday if I don't see you guys before.
Same to you, sir. Thank you. Motion's been made,
Approve the pension.
Second.
motion made and seconded, to approve the pension of Patrick Kelly. All in favor?
Aye.
Aye.
Opposed? Motion carries. Item N, the opt-out for police and fire disabilities. We've had multiple meetings with the town regards to this, getting answers. We're still waiting for the answers. I know I set a meeting just a little while before we had our executive meeting. I live in a black and white world, and this is so much gray, I'm not gonna make it.
There's no gray. This is a black and white situation.
Yeah,
That didn't
well,
make it
it's,
gray.
it would seem that way.
And they wonder why we don't want to negotiate with them, okay? They wonder why we turn their backs on and we hire lawyers on top of lawyers on top of lawyers. Okay?
Getting an answer hasn't been an easy thing. We keep
It's
trying.
such a simple answer, it's ridiculous. Because if you let me talk to Carter when he was here today, I could have got you the answers. Carter would have gave me the answers. Ask Carter, he knows the answers.
Yeah.
So if Carter knows the answers, you know the answers, they know the answers. But you just don't want to tell me the answers. And that's a shame. That's a shame. But status quo for the Westwater Pension Board.
Oh, what do we know?
You know nothing.
Oh, wait, a second.
Motion to table
We do
item
know
N.
something. Okay.
Wish he
I
hadn't
don't know
left,
what he
because
was
I was
talking
just
about.
wanted to him to, it's not, we go to the meetings, we discuss it with them,
What he was
we
talking
can't get answers. It seems to be black and white. I think it should be black and white, but it's not. That's the reality of it. But anyway, we just keep plugging along at it until we get an answer. We cannot make assumptions. We just administer this plan. We make assumptions on the plan. We can't make assumptions of what they intended or what they meant to apply for. We need to get the answers for them. If we don't have the correct answers, and we do something wrong, it could be to the negative of that person, and we don't wanna do that. I don't like to drag it on anymore, I like to redrafts and drag anything else. Some of this stuff's been long before me, and I'm doing my best with it, and this board has. David's been here longer than all of us, and he knows exactly what I'm saying, and when he's been here for long before me. Go ahead.
Problem is, it's been going too long.
Oh.
Way over 2 years, we've been trying to get this answer, so,
Yeah.
and you know it's ridiculous.
And
That's the problem.
it shouldn't be this way. Nobody, they think,
Yeah, but you
and I could be
have
wrong.
Power to have, to answer that question.
The problem is, I need to go to see her to find out what was your intent when you negotiated this. Then I need to go see her and ask her the same question before I can go and make an assumption. If I don't know that information, I could make a wrong assumption. Getting an answer from them and them with the turnover people or trying to get who knows what the answer is by pulling
Well,
teeth.
that's true with you, Al, that's true with you, because you're fairly new. But it's been going on a very long time.
Right.
And every time there's a new person, it gets pushed back, pushed back, pushed back.
That adds to the problem, right.
That's the problem. This gentleman doesn't know what's going on.
No. But,
No offense.
I'm gonna tell you the same thing I told the council when they interviewed me for this board. I take one problem at a time. I can't fix them all in one shot. We all can't, all right? But I spend a lot of time trying to do stuff, get answers to it, and get it so that we don't have to go through this again. The problem I see also is this board is doing some things they shouldn't be doing. It's not our job to do it, looking for this or looking for that. That's council's problem, or that's someone else's, HR or whatever. So sometimes we have to go and ask them questions or look up things and kind of do things that they may be doing, just so we can get some expedition to it and get some answers so that we can get our ball rolling. Otherwise, we sit here month after month. I understand Kevin's frustration
Me too.
and having to say the same thing because we can't get it. We go to a meeting, we can't get into that. We go to this meeting, no, you need to contact that person. It snowballs, but we actually don't get anywhere. And it's frustrating. I understand his frustration. But I will work on it, and we as a board will work on it and get as much as we can. It might take some time, but I want to solve them and get to the next problem and solve that one. Any other discussion? All right, so,
There was a motion made to table by David.
was it made? I was just gonna ask. You made a motion?
To table, yes.
I'll second the motion to table it.
Motion made and seconded
We don't have any-
to table item N till next month. All in favor?
Aye.
Aye.
Opposed? Motion carries. Okay, item O, Ebola Quattro. We have actually got an answer back from the woman, the lawyer who wrote the Quattro.
Correct.
She's in contact with the two lawyers for each of the individuals, and we're waiting back for an answer from them.
Yep, she's gonna actually contact the individuals directly.
Yeah.
And then she will let us know if she needs any calculations performed, and will get back to us on how they want to address the Quadro going forward.
And they do know they will be paid for those? Okay,
They do, correct.
all right. Okay, so we'll table this till next month
Motion to
then?
table item O.
Second the motion to table item O.
Motion made and seconded to table item O till next month. All in favor?
Aye.
Aye.
Opposed? Motion passed. Item P, COLAs for the fire disabilities. We're setting up a meeting with the town manager, he's already gone, discuss different people that are involved in that situation. As soon as we can get a meeting together, hopefully we can get an answer on that problem.
Yeah.
Any other discussion?
That's a meeting that we're hoping to set up for the
Next
17th?
No,
Oh, next
maybe
week?
sometime next week, I'm gonna
Okay.
send an email. I
Okay.
don't know what day.
Motion to table item T.
Also, the other day was maybe Wednesday, which
Yeah.
is 19th, I think it was.
We're looking
Yeah,
for
that
like
would be a better
Wednesday
day.
the 19th,
Yeah.
Yeah, right,
possibly,
the 19th. That would be,
if Ernie has it
Okay.
available.
okay.
We have a motion made to table.
Mhm.
Second the motion to table.
Motion made and seconded to table till next month. All in favor?
Aye.
Aye.
Opposed? Motion carries. Item R is the
Item Q.
Q. Dunn.
REQ for, sorry, I missed Q. Item Q is James Dunn.
We're setting up, trying to set up a meeting with HR, sent an email,
Yeah.
I'm just waiting.
Waiting for dates, right?
You wanna table that one, so.
Mm-hmm.
Motion to table item Q.
Second the motion to table item Q.
Motion made and second to table item Q till next month. All in favor?
Alright,
Aye.
Opposed? Motion carries. Item R, RFQ for legal counsel. We have a tentative appointment, date,
Monday the 17th.
Monday the 17th. Has the board here to discuss, our procedure. What's that?
We're gonna discuss evaluation criteria on December 17th.
Evaluation criteria on the 17th for this, and then we're looking to do interviews next month
Yeah, probably, early January.
in January. Any other discussion? Okay,
Yes, you can,
this should be tabled also, right?
probably table.
motion to
it,
table
yes.
item R.
Second the motion to table item R to next month.
Motion made and seconded, table item R till next month. All in favor?
Aye.
Opposed? Motion carries. Item S, pension board opinion request forms. When can,
That's going to HR, remember,
yeah,
about, so you can table it.
yeah, so we can table that.
Okay.
Motion to table item S1.
Second the motion to table S1.
Motion made and seconded to table item S1 till next month. All in favor?
Aye.
Opposed? Motion carries. Item T, Peter Blaze, that is,
Mr. Blaze is currently on workers' compensation.
Yep.
And he has asked questions about calculations of his benefits if he were to apply for a disability pension versus if he were to work until what would be what he believes to be his normal retirement date. The board typically gives one calculation, it's one free calculation. And the application that has been submitted at this time is a disability application. So we could calculate what his disability benefit would be were he to be approved for a disability pension. But he's also asking for the calculation of what would be his normal pension benefit if he were to continue to be on workers' comp until what would be his normal retirement date. My thought, just thinking ahead, would be he would need the calculation to be run to know what his pension benefit would be if he worked until that date, but he would also most likely want to know what his buyback amount would be were he to need those, whatever the time that is that we were on comp to pay back for his pension benefits, so that would count as continuous service. I know the pension plan typically pays for one calculation, and he's looking for two. I don't believe that we have any of the figures we would need right now to calculate a buyback or to calculate any of the, what time he would need to buy back if there's any other breaks in service or anything like that. My thought would be that the clerk could get the information and start figuring out what would his normal retirement be, does he have any other breaks in service, what the buyback amount would be, because I think we figure all that out, right, Tracy?
We will go through, myself and
Right.
and figure out any gaps if I got the history, but the school department doesn't usually send me that full
I
history,
remember.
like my payroll department, so I would have to request all the paychecks unless they gave us the gaps.
Unless they give us whatever gaps they had, which maybe we can ask for and
We
see
could
if
ask
they
for
have
it that
those.
way.
Hopefully, that would make it a little bit easier to figure out the calculation of the buyback.
I'm not sure which way is
Um,
easier, or to order the 10, because they would be 10 years back as well.
Right,
If not, I'd have to.
which we would need either way, right, for either
Right.
calculation, yeah.
So if not, we would have to get the full history, and we would have to look through it, so I don't know.
do you know how much he's short for retirement?
I don't,
No? Okay.
you know.
I don't know. I believe it's coming up sometime within the next 6 months based on my conversations, but I haven't actually looked at the numbers or
Well,
tried to
that's
figure
going
out
to
a
be
date yet.
another thing. They're not going to have that 6 months ahead in wages
the
To
best
project it.
estimate of projection of what the salary would
Right.
have been and what the contribution would have been.
It's kind of messy that way.
Maybe
Yeah,
the best thing
very
to do
messy.
is to tell them we only pay for one,
Right, Ralph?
figure, set of
Very
figures.
messy.
And right now, there's not enough information to maybe give them an accurate answer on one way or another, disability or whatever. And they might wanna wait until he gets a more definitive position of what he's gonna be, and then we can get that answer, be more accurate.
I think the problem with waiting is it's apply for a disability pension now versus apply for a normal pension, whatever it is. I don't know the exact time frame, but say 6 months from now. So I don't know that he has the option of waiting, because I think he kind of needs the figures to be able to determine which one is his best option.
You do have an application, right?
We do,
Yes, it was
What kind?
a
disability.
disability,
Okay.
so that would be the one.
So the thing that actuary's gonna need is service time? And that's
For a
something,
disability application, they wouldn't need the years back. They would just need,
No, they would.
they would need, the 10 years, 'cause it's
It's
school
still,
again. I
because we're
forgot
not
it's
like
school
police
again.
and fire, not
Yeah.
of rank, they still go by.
Right, the
Yeah.
10-year average.
so you're gonna need to know
So we're
that.
gonna
Either
need it
which
no
way,
matter what.
I need to know 10 years back.
Yeah.
The only thing is, it's going to be from the date we order now, they're gonna have to project
The next 6 months.
next 6 months. So have to take his
Well, we'll need the
wages.
10 years back no matter what, because if it does go with a disability application, you need the 10 years back from now.
Right, but if I go 10 years back from now, those figures will not be accurate.
Right.
Because you need to go 6 months ahead.
Only for the normal, but not for the disability.
Well, yeah, the disability will be when he signs off workers' comp.
Right. Which
So
could be
either which way,
tomorrow.
that's why I'm saying, it's
Yeah.
very confusing. Either way, you're not going to get an accurate amount. He's gonna be reordering no matter what, because you're gonna
But
be
then he's gonna be
projecting
paying for it.
ahead.
But we could do a projection, in theory,
You
of
could.
of what a monthly normal benefit would be versus what a monthly disability benefit would be.
You could, but it's just gonna
Or
be
whatever way
more
he's gonna
money
get to it,
each
depending
time.
on what we the offset of workman's comp time.
Well, right, if it's a disability, wait, I need to use my brain for a sec. Right, he would need to figure out the offset if there is any kind of a lump sum payment,
say
which
he's
we don't
got-
know that yet.
9 months workman's comp.
Yes,
As long as he understands that whatever information we give him for X amount of date, that he would actually have to work that 9 months more or whatever to get, you know what I'm
to
saying?
that point, right.
Whether he's still disabled or he comes back, see, he's applied for disability, so has he gone through any of the procedures under disability?
No,
No.
because you can't,
He's on comp.
because he's on comp.
Right, so he really, there should be, I think it's not good to do it now, but.
I understand completely. I'm not disagreeing with you.
No,
Warren.
I'm
I
just-
completely understand what you're saying about the
I
figures
don't
not
think
being
it's fair to
accurate.
him or fair to the board.
But he doesn't have the ability to make the decision without knowing what the two different monthly amounts would be.
Yeah, but it's either, he's applied for disability. What was the other amount you talked about?
If he's on workers' comp for enough time that it reaches what would have been his normal retirement date, he would be able to withdraw his disability application and just apply for a normal pension. But he doesn't know what the two different amounts would be. So whether or not that's better or worse, he has no way of knowing that.
Let me just say this, right?
Is
If
that
he's
our
truly-
job to do that?
Well, if we can request a calculation, that's certainly what we would do. And the question is if he wants to request a second calculation.
Well, right off the top of my head, wouldn't a disability pension be more? Because you're gonna get a higher percent than if you have your 25 years, you're only gonna get.
I don't know.
But it would be the same figures that we would be using. Think about it.
But I just don't know what his normal retirement would be based off of, because I have no idea. I don't
But
know
if
what
he's
we're talking
aiming
about.
towards it would only be 25 years, which,
Right, we wouldn't be 66 and 2/3.
no, that's what I guess I'm trying to say,
Right.
so it's kind
But
of
it
like,
also wouldn't have an offset.
it wouldn't have an offset. But
Which
he
might
also
be
has
the
to pay a
problem.
buyback with interest.
Correct.
So.
And
I
that's
don't
why
know,
I think
yeah.
he doesn't understand which
Yeah,
one
he'll-
would work out
That's very
better.
complicated.
Well, the other
Right.
But
thing,
if we pay to have a done. And whenever down the road comes, if he, whatever changes, that figure's not gonna be accurate, he's gonna,
Correct.
You're right.
It would be an
who's gonna pay for
estimate.
that next time when he actually, okay, this is my actual retirement date?
He'd have to pay again.
He would have to pay then to get
Well, I
that
thought we
figure.
would give, I thought the board allowed people to have one-time
He would have
pre-retirement.
one. But if he
Right.
wants his disability, wants a normal right now, plus his buyback,
Right, oh, I'm just saying that there would be one that would be thrown in, but then whenever he actually picked whichever option it would be, that would be something the board would pay for that calculation.
So we'd be paying for two then,
Correct.
but we only pay for one.
Pay for one before the person has applied, is my understanding, I could be wrong.
But he's
I-
applied. Thought he already applied for the disability.
He put the application in.
Correct, but we haven't accepted it because he's still an employee.
Oh, okay.
See, that's the
can't-
problem with workers' comp, you can't be an employee collecting
So it really doesn't make any sense for
comp.
us to pay and do something, because there's no definitive answer one way or the other. He may go on workman's comp and then, oh, now he's reached his normal retirement age and decide just to go right along with retirement.
There's probably one other thing he's not really thinking about either. When you're on workman's comp, you don't pay any income tax on that money. But when you're on disability pension, you pay income tax on that money.
No,
No.
Yes, a disability pension, you pay income tax on that money.
no,
Yeah.
it's tax-free.
Not disability.
if it's an occupational disability, it's tax-free. If it's a non-occupational
If I get in-
disability, you pay tax.
If I was got injured and disabled and I had to retire on a disability instead of regular pension like I did, 66 and 2/3, tax-free for the rest of my life.
Mhm. But Helene, if you go out on a non-occupational, like just like, God
Right.
forbid, like something, you do pay income
But
tax.
Okay.
no.
He doesn't know which way it's gonna be
Yeah.
yet. He's trying to figure it out, but we really, he's gonna get shortchanged, I think, and I don't think it's fair to him. I don't think he realized it. We pay to do one set of figures now, there's not a lot of information to come up with a good, accurate figure. They can project stuff, am I correct?
Right, no, I agree.
And so, it's not gonna really help him, because if his situation's different now, he's gonna have to get figures, he's gonna have to pay for those figures. To get that actual thing, whatever the decision is, he gonna be totally disabled, or is he gonna just go out on
So
a?
we just say to him that either way, the figures won't be accurate until he's off of comp, so it's best to just run the figures after comp, and we can run them two ways.
Because then you would get the offset amount.
Then we would know.
Well, that's the problem.
Oh,
Is he's trying to decide,
Whether
Which-
to
Oh,
get
he-
off of comp.
He's gonna
correct.
wait till then anyway.
but he doesn't, because if he,
If he hits his normal retirement date, is that what
Correct.
you're saying? But then he still has to buy back all the money.
correct,
But does he 100% know that he's gonna have enough years?
I don't know the answer to that.
He should probably talk to him.
I'm sure he has a workers' comp attorney, then I'm gonna say that that's something that they
He
should.
does,
Yeah.
correct.
That's why I got legal involved. I didn't wanna communicate anymore.
Either way, I don't think we should be running figures
No,
today or
I don't,
tomorrow. I think-
I don't think it's fair to everybody all the way around. It's not gonna come up with an answer.
No,
That's
That's gonna be-
the liability.
I'm gonna come up with a good answer later.
My suggestion is that we just, send him an email, how do you, do we?
Kind of
email?
No, I've been out of it because he has
He had an
workers'
attorney,
comp,
so you
so
had
I
me
handed it
contact
over
him.
to
Okay.
Krista.
But then I suggest you contact that attorney and explain what we've just talked about. And, because we haven't accepted it, because the reason why, and then see what their response is. But I don't think we should do anything on it until it's a definite decision by him which way he's gonna go, disability or regular retirement. Because there's just too much unanswered to give it's not fair to him or the board or anybody.
Well, Krista, does it matter also, because he already applied?
We didn't,
We could
we
No,
withdraw
I know
it,
we didn't because of that, but that doesn't matter, right?
he could withdraw
He
it
can
and
just
just
withdraw it.
apply
we
for
haven't
it, yeah.
accepted it.
Yeah.
So it's like we haven't, it came in here, but it never went.
Well, because he's on workers' comp, he
Right,
had to
so
stop.
it's-
So I was just curious what he had to do.
Whether it's set on his desk or our desk, it's the same difference right now. It hasn't bought into the file cabinet. Just use an expression. Sorry.
I was like looking at you.
I'll call the
Yeah,
attorney
just
and I'll have a
table it.
discussion about what the board had just expressed.
So then we'll just table it till next month.
Sure, I'll report back.
Motion to table item T.
Second the motion to table item T.
Motion made and second, table item T, table item T till next month. All in favor?
Aye.
Opposed? Motion carries. Item U, COLA for non-union. That was.
It's gonna be HR about the handbook.
Yep.
So we're trying to get an appointment, so you can table it.
Motion to table item U.
Second the motion to table item U.
Motion made and seconded to table item U till next month. All in favor?
Aye.
Aye.
Opposed? Motion carries. Item V, school question for reemployment post-retirement. That proved interesting because our legal has found where there was guidelines for a person to come back to work when they rewrote in the 06 of the plan, right?
So what we talked about, the question came up last month, and the board asked the clerk to find an ordinance that applied to regulations as far as what someone who is retired would be able to come back and work for the town and earn if there were limitations on the number of hours or the amount of money that the person could make. So the clerk looked for that ordinance and found an ordinance from 2002 that did address the situation and discussed a maximum number of hours that could be worked, a maximum number of amount that can be earned. The only issue that I found on just first glance at the ordinance is looking at it, the ordinance is ordinance number 2002-13, which amends the West Warwick Pension Plan excluding police and fire, and adds basically an amendment to section 5.08 and adds a section 5.08.1. However, looking at the ordinance, it appears that the ordinance is amending the 2001 pension plan. And when we look at the 2006 pension plan, which is the current document that the board is following, it does not appear to have made it into the 2006 plan. Section 5.08 or section 5.08.1, discussing the reemployment of retired members is not in the 06 plan that I can see. I have not researched the plan or the history to see if there was any kind of a voluntary change of the ordinance or an involuntary change of the ordinance, if it's that someone just missed incorporating it into the 06 plan versus if the town council made a conscious decision to not include it in the 2006 plan. That's not something that I have done. I didn't want to do that without having talked to the board first. But we do have this 02 ordinance as to the plan excluding police and fire. I'm aware that there are more recent ordinances to the plan for police and fire. But my suggestion to the board would be to communicate to the town council the fact that this is the ordinance that the clerk was able to find, that it's from 2002 and appears to amend the 2001 plan. And see if the town council can provide direction as to, is there an ordinance amending the 2006 plan, or is there any history as far as when the 2006 plan was adopted, the intent toward this ordinance, and get the information, feedback from the town council as to what had changed with the 2006 plan. If town council did intend to include this language into the 06 plan, they could propose a new ordinance to amend the plan accordingly. It would be something that would be up to them, but as far as I can see, this is just what the clerk had found for me, was the 02 ordinance. I have not looked further to see if there is any kind of an ordinance that's amending the 06 plan, but I know the clerk did meet with the town clerk.
The deputy.
Oh, sorry, the
Help
deputy
me.
town clerk.
Mhm.
An attempt to find a more recent ordinance, but wasn't able to find one.
Was it an ordinance that went from 02 to 06 to make changes?
So the plan was the 01 plan.
Okay.
So any changes from 02 to 06 would have amended the 01 plan. And then when
Okay.
the plan changed in 06, that in theory would have incorporated whatever ordinances had happened between 01 and 06. I don't know why this isn't
All right.
into the 06 plan.
So I'm getting at though is there had to be some kind of legal document saying we're gonna use this now, this is gonna be the plan and the rules and guidelines.
Yeah, the 06 plan was
Right.
passed as its own ordinance.
Okay,
Yeah.
so then that's what we have to go by.
Is the 06 plan.
So if we answer the question based on that, is no, you cannot work, come
It's-
back to work.
I
for the-
haven't completely
Oh, I'm saying just by
analyzed it,
that, right,
but it would be very different if you look at the 06 plan versus the 02 ordinance.
right, but I'm saying just that here, right, the 06 plan is what we
What we
mentioned.
have.
Right,
Mhm.
so the only thing that, we can answer the person based on this, that, but, this question's gonna come up again,
Mhm.
so we should maybe contact council
I would
and
recommend
find
that.
out if this was intentionally left out, or if it was an oversight, and then let them figure it out and make whatever decision, and whichever way, and then we'll know.
So I make a motion that we table item B until next month to give our clerk the opportunity to contact the town council and ask them questions.
Second.
Motion made and seconded to table item V and have the clerk contact the council and get the answer to the questions that we just discussed. All in favor?
Aye.
Aye.
Opposed? Motion carries. Okay, item W, discussion. Anything here for the board members want to talk about? Tracy? All right, then we go to public comment.
Public comment?
Discussion,
Come
Oh,
on
you
up.
want to do discussion?
well, whatever, I think that's.
Public
what
comment,
today.
yeah.
Okay.
Come on up. What's your name and
Where-
where you live?
All right, I'm Michelle Lombardi, live on Providence Street, West Warwick. I applied for the vacancy for the pension board. I have worked for the city of Providence for 20 years. I'm a retiree there. I have my master's in accounting. I also represent people in tax court as well as do accounting and about 1,000 tax returns per year.
So you applied, so the town council has to approve it.
Hmm.
But, boy, I would be happy to have you on board.
I did apply about 2 months ago, well, 2 meetings ago, and Mr. Goslin reached out to me on Facebook and told me to contact the chairman here, which I did, and we spoke today for a bit on the phone, and he just recommended that I come in here today and come up to the podium.
Yeah, I have I don't know if anybody else has some questions, but I got a couple questions. Because I spoke with Mr. Goslin, as she said, and he asked me to reach out to her and ask her questions and get some input from her, so that make a recommendation back to him. As far as your being on this board, what is it that you can feel that you can do for either the plan or for the taxpayers or the people that are in the plan, the retirees?
Just probably help vote on important issues that would be in the best interest of everyone and try to resolve problems.
What is it that you could, voting is, voting's one thing, but what is it you could bring to the board that would make
My
your...
financial background, which I
Okay.
quite intense.
Yeah. You've done a lot of investments?
I work with investments. I have clients that work with investments, pension plans. I've been a local 1033 member for over 20 years and also a union steward. I work for the Providence Police Department,
Which department?
Providence Police Department.
Okay. That's all I can think of.
Have you served on any municipal boards before?
No, I have 2 children, single parent,
That's fine.
had a little struggle there dealing with my full-time job and putting myself through school to master's level and beyond. I'm going into a doctoral program, so just kind of, keeping up.
Are you aware that this board meets basically from 5 to 9, once a month?
yeah, that's not a
And-
problem
Okay,
for me.
and are you aware that we also have other meetings because we've got a few projects that we need to
Yeah,
finish?
projects, yeah,
Mhm.
good work. Yeah.
I pretty much make my own hours at work,
Okay.
and I have an open schedule. I work during tax season with clients, that's 16 weeks. But as far as that, I'm not working the rest of the year.
Is that tax season gonna interfere with you meeting the meeting?
No, I make my own schedule. I meet with clients based on my own schedule.
Any other questions?
Very good.
Okay, thank you.
Thank you for sitting through the.
Okay.
That was a
Thank
long,
you.
It's a long, this is a long meeting, yes.
Yeah,
Thank you for-
I was just, this is off the side, whatever. So with the actuary or whatever, I mean, I know someone brought up the idea of possibly looking for an alternate, alternate investment firm or whatever, but they do have firms out there that don't charge. I mean, he says that they charge 3% them. I mean, I'm wondering if maybe shopping around a little?
No, I think it's 0.3.
0.3%, 0.3%.
We had shopped around, when we first picked them up in 2015. We probably had 15 or 16 applicants. And, I mean, we sent out the RFPs, RFQs and everything and had a whole process to select them. It wasn't just like
Yeah.
oh, we like them, let's pick them.
All
We
right,
had a whole interview process.
What about the other option there with having the state help?
Going to
with-
MERS, he did bring that up. That's proposed legislation. I don't think it's anything that's finalized yet. They've been talking about
It's
that
never
for a
been,
couple of years.
it's never made it through.
So there's nothing
Yeah.
that's actually available yet.
He came as, it said before, he came to the meeting for our other organization and made his pitch. And he did it to the other, 2 of our organizations. But the bill has never made it through legislation, so it hasn't passed. There's some positives to joining it. There's a couple negative things, so we haven't really, it's been suggested that this board send a recommendation to the council to let the assembly know that they're in favor of that, so that that bill could be put in and passed. But until that passes, really nothing that we can do. We have to wait and see if the bill passes, and then what, is there any terms? Is it in the play, or as they said, let them just manage it, the chief had said, let them just manage it, all right? And so it depends on how you're gonna work it out as to whether or not it's gonna be good for us to do that. Obviously, we're struggling. We're a little bit better, but as she pointed out, that not everything has been out with the 5-year plan to speak. So my concern is the 5-year plan is done very shortly, and what's gonna happen next? So, taxes are high, nobody likes that. I live here, I pay the taxes, so I know what everybody's saying, but we'll just wait and see how it goes.
Okay, thank you.
Thank you.
All right,
Thank you so
bye-bye.
much. Okay, so
Mr.
make a mo-
Masachi, do you have anything you'd like to say?
No, we're quiet again tonight.
Motion to adjourn?
Second motion to adjourn?
Motion made and seconded to adjourn.